Hi, I'm Jimmy. In this video, we're looking at the yield curve, what the yield curve is, and in this video, we're going to use the Treasury yield curve as our example. We're going to look at how the Treasury yield curve can be used to predict where the economy is going, and then we're going to take a peek at what industries could be most impacted by the current situation of where the yield curve is. But before we jump into that, let me tell you real quick about our private investing community as well as our investing website that we're building. So we've got our private investing community hosted over on Discord. On Discord, we got a whole bunch of different investing channels where we all talk, share ideas, do some research projects together, and ultimately try to get better as a community at investing. We also do a couple investing live streams, private investing live streams every week. Some we do a valuation live stream, we do a portfolio live stream where we talk about my portfolio, we build the different portfolios. Plus we do a research live stream where we try to analyze companies together and go through the process together so we could all get better at it. Okay, now let me tell you about the website that we're building. So we already built the beta version of our discounted cash flow calculator. And the idea is that we would have a website that has a bunch of different valuation methods. So it could be, how do you value banks? How do you value a large cap company? How do you value a real estate company? How do you value a company with no growth or negative free cash flow or negative profits? There's different ways to value all different types of companies. So that's where the website's trying to go. For now, we've already got the beta version of the DCF calculator up there. We're just going to keep adding from there. Now, if you'd like to sign up to get access to our investing community as well as the website, I will leave a link in the description below. So this is an example of a Treasury yield curve. And what the Treasury yield curve is ultimately telling us is it is telling us the interest rate we would get paid for investing in this case, a Treasury at different maturities. So how much would we get paid for investing in a 3-month Treasury or a 6-month Treasury or 1 year, 5 year, 10 year? You can do this for any type of bond. So let's say you were looking at a Treasury yield curve for AAA corporate bonds. How does that Treasury yield curve, how does that yield curve look? This, like I said, is the Treasury yield curve. Now, this is the actual Treasury yield curve as of December of 2021. We're going to fast forward in a second, but before we do, I just want to clarify one thing about Treasury yield curves specifically. They actually have different names for different time periods, different bonds, investments over different time periods. For example, if it's less than 1 year, they actually call it a T-bill, not a T-bond. If it's 2 years to 10 years, they actually call that a Treasury note or a T-note. If it's 20 or 30 years, they actually call those T-bonds. So if you wanted to invest in, a Treasury for, let's say, 6 months, that is a T-bill, not a T-bond. Just so we're aware of the differences if anybody happens to see them out there. Now, the important part for us to remember here is ultimately the shape of the yield curve. This is by far the most important part. This is what they call a normal yield curve. It is upward sloping, which is exactly what we want. But let's fast forward through time just so we can see what has happened since the start of the year. Now, the important part here is the Federal Reserve started increasing interest rates to try to help combat inflation. Now, if you ever wondered why the Federal Reserve knew inflation wasn't a problem, why didn't they just up interest rates right away to 5%? Why do 75 basis points every couple months? Well, one of the reasons is that the Federal Reserve ultimately controls the short end of the yield curve. They control what short-term rates do, specifically overnight rates. They control that, so really they raise the interest rate up on the short end, and the rest of them should naturally adjust. But when we look at today's yield curve, we can see that this yield curve is much, much flatter than it was at the end of last year in December of 2021, which was upward sloping, the ideal yield curve. This one is much, much flatter. In fact, I would say that this yield curve is inverted. To illustrate, we can see that the 2-year rate is currently yielding more than the 10-year rate. So ultimately, what that means is that if we invested in a 2-year Treasury, well, we would get a higher annual interest rate. By the way, all these interest rates are on annual numbers. Interest rates are always annual. Well, we would get a higher interest rate than we would if we invested for 10 years. There's a problem with that. That should not happen. There is more risk the longer you go out. Short-term rates should yield less than long-term rates. So technically, this is an inverted yield curve, and an inverted yield curve generally predicts a recession. Every recession the country has had for like the past 100 or so years has been preceded by an inverted yield curve. We'll get into why in a second. Before we jump into that, I just want to look real quick at the general volatility that comes about, or the yield curve volatility. So this is a chart of the volatility of the different investments as of today. So basically what it does is it looks at the volatility over the past 360 days for each individual investment. Now this chart is exactly what we would expect to see for a traditional treasury yield curve. Short-term interest rates should be more volatile than long-term interest rates. But it's important to recognize that short-term interest rates are most influenced by monetary policy. So everything in the short end, because they influence overnight rates, is affected by monetary policy, while longer-term rates are most influenced by changes in the real economy and inflation. Now, we've seen that happen as well, but because the Federal Reserve moves faster on the front end, that is why we saw such a gradual shift, such a dramatic shift to a flattening of the yield curve, and recently an inversion of the yield curve, which again tends to be a bad sign for the economy. Now, generally, there's a lag between when the yield curve inverts and how long before a recession ultimately happens. Now, it's generally accepted that the lag is about 12 to 18 months, although I've seen some studies that have come out and said that it could be as short as 6 months or as long as 24 months. So it's somewhere in that area. Point is, it doesn't happen immediately. And just because the yield curve inverts doesn't mean it always will cause a recession. There have been inversions of the yield curve that didn't lead to recessions, but there has not been a recession that was not preceded by an inversion of the yield curve. So just something to keep in mind. Okay, now let's look at some industries that could be most impacted by an inverted yield curve. So I would argue that almost all industries are impacted by an inverted yield curve because an inversion of the yield curve hurts the economy. But by far the most affected industry is the banking industry. And this is because banks borrow money at short-term rates. They borrow money from people like us. If we make a deposit into the bank, that is them borrowing money. They will pay us interest for that. Well, they pay those based on short-term rates. They then lend out money at long-term rates. So what happens when there's an inversion of the yield curve where they borrow money at short-term rates, they're paying out interest, and that's higher than what they can collect for it? Well, ultimately, what will happen is those banks will slow down the number of loans that they're making. Those loans, this explains the lag in the economy. Those loans don't get made, that hurts the economy down the line. That doesn't happen today. They're already, no matter what interest rates are, they're currently closing deals based on interest rates from the recent history, which again explains why the Federal Reserve is so cautious about how quickly they're increasing interest rates. They want to slow things down, cool off inflation, but they don't want to bring everything to an absolute halt. If they jolted up interest rates, in the short-term interest rates, to like 5% overnight, well, that would force banks to pretty much stop lending because they cannot borrow money at that interest rate and lend it out for a lower interest rate for any sustainable period of time. So if we're long-term investors, personally, I think one of the most interesting industries to look at right now is the banking industry, because this is common knowledge that banks are going to get hurt. And if banks are going to get hurt, a lot of times those stocks will be down right now. And if we're long-term investors that plan on holding this for a long period of time, well, when the yield curve corrects itself, and surely at some point it will, well, when it does, the banking stocks are likely to recover. Now, if you'd like to sign up to get access to the website, well, I will leave a link in the description below. And thank you so much for sticking with me all the way to the end of the video. I really do appreciate it. Thank you, and I'll see you in the next video.